What if I told you that one simple book could transform how you think about money forever? Warren Buffett calls it the greatest investing book ever written, and when he read it at 19, it completely changed his life. Today, that same man is worth around $150 billion, making him one of the most successful investors in human history. The book is The Intelligent Investor by Benjamin Graham, and the principles inside don't just work for billionaires. They work for anyone who wants to make smarter financial decisions and build real wealth over time. Most people think investing is some complicated game reserved for Wall Street experts with fancy degrees and insider information. But here's the truth Graham discovered decades ago, and Buffett has proven ever since. Successful investing isn't about being the smartest person in the room or predicting what happens next week. It's about having the right framework for making decisions and keeping your emotions from sabotaging your financial future. Today, I'm sharing the most powerful lessons from this legendary book. These aren't abstract theories that sound good on paper. These are practical principles that can protect you from costly mistakes and help you build wealth the intelligent way. And I've saved the most important lesson for last, because once you understand it, everything else falls into place. Let me start with what might be the most brilliant concept in the entire book, the story of Mr. Market. Imagine you own a small business, maybe a local coffee shop. Nothing fancy, but it makes good money with regular customers and steady profits. You love running this place. Now picture this. Every single morning, a neighbor named Mr. Market comes rushing into your shop with a wild offer to buy your business. Monday morning, he storms in practically bouncing off the walls. "Coffee is the future," he shouts. "Everyone needs caffeine. I'll give you $2 million for this place right now." You think he's lost his mind, but you note the offer. Tuesday morning, same guy drags himself through your door looking completely defeated. "Coffee is dead," he mumbles. "Nobody drinks this stuff anymore. I'll give you $50,000, but you should sell before it's too late." Wednesday, he's back with a completely different energy. "Good news," he announces. "I changed my mind. Coffee's cool again. $700,000. Final offer." This continues every single day. Different moods, different offers, same crazy neighbor. Now here's the key question. Would you take this guy seriously when deciding what your coffee shop is actually worth? Of course not. You'd laugh, roll your eyes, and tell him to come back when he's thinking clearly. You know your business generates consistent profits, serves loyal customers, and has real value. That doesn't change based on one person's daily emotional roller coaster. But here's where it gets interesting. When it comes to the stock market, people treat Mr. Market like he's some kind of financial genius. Stock prices go up, everyone suddenly thinks they're investment wizards. Prices go down, panic sets in, and everyone starts selling. Why does this happen? Because the market looks official with its screens and charts and constant news coverage. It feels serious and important, so people assume the daily price movements must mean something profound. Graham's brilliant insight is that Mr. Market's behavior in the stock market is no more rational than your crazy neighbor's daily offers. The market is driven by emotions, fear, greed, and mob psychology. Most of the time, these emotions push prices away from what businesses are actually worth. When you buy a stock, you're not just buying some ticker symbol that bounces around on a chart. You're buying a piece of a real business with employees, products, customers, and actual value. Think about what happened during the 2008 financial crisis. American Express stock dropped 75% in less than a year. Now, there were legitimate concerns about the financial system, but American Express is a massive global network processing hundreds of billions in transactions annually. The idea that this entire business infrastructure suddenly became 75% less valuable in 12 months? That was Mr. Market having one of his emotional breakdowns. Investors who understood this principle didn't panic. They recognized an opportunity. Those who simply held their shares recovered completely and saw gains of over 500% from the pre-crisis peak. But the really smart money, the investors who bought more shares when Mr. Market was at his most irrational, saw returns of over 2,000% in just 15 years. A $100,000 investment at the bottom became worth $2.6 million. Here's a more recent example for anyone who lived through 2020. When the pandemic hit, Marriott stock crashed 60% in just 6 weeks. Marriott is a company worth tens of billions with thousands of properties across 140 countries. Yes, travel was uncertain, but a 60% drop in 6 weeks? That was pure panic, not rational analysis. Investors who recognized Mr. Market's overreaction and bought Marriott during the crash made over 300% returns in just 4 years. This brings us to Warren Buffett's famous wisdom that perfectly captures this concept. Be fearful when others are greedy, and greedy when others are fearful. The smart money moves opposite to the crowd's emotions. When everyone else is panicking and selling, that's often when the best opportunities appear. When everyone's throwing money around like it's free candy, that's usually time to be more cautious. But understanding Mr. Market is just the beginning. The second crucial lesson from Graham is what he calls the margin of safety, and this principle can save you from devastating losses. Here's the core idea. No matter how smart you are or how thoroughly you research an investment, things can go wrong. The economy can shift unexpectedly. Companies can make terrible decisions. Market sentiment can turn ugly for reasons nobody saw coming. You need protection against the unknown. Think of it like building a bridge. If trucks crossing your bridge weigh 10,000 pounds, do you design it to handle exactly 10,000 pounds? Absolutely not. You build it to support 30,000 pounds or more. That extra strength is your safety margin, protecting against unexpected stress or miscalculations. The same principle applies to investing. Let's say you've analyzed a company thoroughly and determined it's worth $50 per share. Do you buy it at $50? No. Do you even buy it at $45? Still no. You wait patiently until you can buy it at $30 or less. That gap between what you think it's worth and what you pay is your margin of safety. It protects you if your analysis was slightly wrong or if temporary problems affect the business. During the 2008 crisis, legendary investors like Warren Buffett weren't just sitting on the sidelines feeling sorry for panicked sellers. They were actively buying solid companies trading far below their intrinsic value. Johnson & Johnson, Coca-Cola, and other high-quality businesses were available at massive discounts, simply because fear had taken over the market. That's when you strike, when you can buy great businesses with huge margins of safety. People always ask what happens if you love a company, but the stock price keeps rising. Maybe you've done your homework on Apple. You believe in the business long term, but the stock just keeps climbing higher and higher. The temptation is strong to jump in because of FOMO, right? Don't do it. A great business at the wrong price is still a bad investment. If it's overpriced today, you don't chase it. You add it to your watch list, follow the business fundamentals, and wait patiently for Mr. Market to have another one of his mood swings. Warren Buffett once said the stock market is designed to transfer money from the impatient to the patient. Your competitive advantage isn't just knowing what to buy. It's knowing when to buy, waiting for prices that give you room for error and solid upside potential while limiting your downside risk. This connects directly to the third major lesson, understanding the fundamental difference between defensive and enterprising investors. Graham was crystal clear about this distinction because it determines your entire approach to building wealth. You can't be somewhere in the middle. You need to pick a side and commit to it. Think of two different people at a gym. The first person shows up casually, jogs a little, lifts some light weights, feels good about staying healthy, then goes home. They're not trying to compete in bodybuilding contests. They just want basic fitness without getting hurt. That's your defensive investor. The second person has a detailed plan, works with a coach, follows strict meal prep routines, takes supplements, tracks every workout religiously. They want serious results, and they're putting in serious work. That's your enterprising investor. Both approaches can work brilliantly, but only if you know which one fits your situation and you stick to it consistently. If you're a defensive investor, here's what that looks like in practice. You don't chase individual stocks based on tips or headlines. You don't try to time the market or treat financial news like breaking emergency updates. Instead, you invest in broad, diversified index funds like those tracking the S&P 500. You might add some bonds depending on your age and risk tolerance. The defensive approach means investing the same amount consistently every month, regardless of whether markets are up, down, or sideways. This is called dollar cost averaging, and it removes the impossible task of trying to time your purchases perfectly. You check your portfolio maybe once per year, rebalance if needed, then let compound growth do its magic over decades. This is how most people should build wealth because it works and it does not require you to become a financial expert. But if you're genuinely passionate about analyzing businesses, love reading financial statements, and want to hunt for undervalued companies like a financial detective, then go the enterprising route. That's what young Warren Buffett did. But understand this path requires serious work, patience, discipline, and extensive knowledge. Most people don't have the time, skill, or genuine interest to do this properly. Graham was emphatic about avoiding the middle ground because that's where people get destroyed financially. They end up chasing trends, buying high, selling low, and panicking whenever prices move against them. Pick your approach and stick with it. Now we come to what I consider the fourth essential lesson, though it builds on everything we've covered, the critical importance of emotional discipline. Benjamin Graham understood something that most people refuse to admit. Your emotions are probably your biggest enemy when it comes to building wealth. The difference between successful investors and broke ones isn't intelligence or access to secret information. It's emotional discipline. We see this pattern constantly. Markets drop 5%, and suddenly everyone acts like civilization is ending. People start panic selling perfectly good investments. Meanwhile, those same investments were up 40% the previous year. But somehow, a temporary decline feels catastrophic, or the opposite happens. Some random stock explodes overnight, everyone starts making memes and posting screenshots on social media. Greed kicks in, FOMO takes over, and people start throwing money at things they don't understand. Look at history. Markets crash regularly, then rebound, then crash again. During the dot-com bubble of 1999, The 2008 financial crisis or the 2020 pandemic panic, some people lost their minds and sold everything at the worst possible times. Others stayed calm, kept buying quality businesses, and ignored the noise. Guess who ended up wealthier a few years later? The key insight is that markets will always go up and down, sometimes for reasons that make no logical sense whatsoever. Your job isn't to control or predict these movements. Your job is to control yourself and stick to your plan, regardless of what Mr. Market is doing on any given day. When you have a systematic approach, you don't need to make emotional decisions based on panic or hype. This emotional discipline becomes the foundation that holds everything else together. Without it, none of the other principles matter. You could understand Mr. Market perfectly, calculate margins of safety like a pro, and know exactly whether you're defensive or enterprising. But if you can't control your emotions when things get volatile, you'll still make costly mistakes. Which brings us to the final and most important lesson, the one that ties everything together and can literally transform how you think about money forever. This is the principle that separates truly intelligent investors from everyone else, and once you grasp it, you'll never look at investing the same way again. The ultimate lesson from the intelligent investor is this: successful investing is not about beating the market or finding the next big winner. It's about not losing money on stupid decisions. Graham's entire philosophy centers on capital preservation first, growth second. This might sound boring or overly cautious, but it's actually the most powerful wealth-building strategy ever discovered. Think about it mathematically. If you lose 50% of your money, you need a 100% gain just to get back to even. Lose 70%, and you need a 230% gain to recover. These aren't just numbers on a page. They represent years or even decades of setbacks in your financial life. The wealthy understand that protecting against major losses is far more important than chasing spectacular gains. This is why margin of safety isn't just a nice idea, it's absolutely critical. This is why understanding Mr. Market's emotional swings gives you such a massive advantage. This is why choosing between defensive and enterprising approaches and sticking to your choice protects you from costly flip-flopping. And this is why emotional discipline becomes the skill that determines whether you build wealth or just accumulate expensive lessons. When you focus on not losing money, something magical happens. You start making much better decisions automatically. You stop chasing hot stocks because you realize the downside risk is too high. You stop trying to time the market because you understand that being wrong could cost you years of progress. You stop making impulsive moves based on headlines because you know that emotional decisions usually lead to losses. Instead, you develop patience. You wait for genuine opportunities where the risk is low and the potential reward is solid. You buy quality businesses at reasonable prices rather than mediocre businesses at any price. You diversify properly instead of betting everything on your latest conviction. You think in decades instead of days. This patient, safety-first approach doesn't mean you'll get rich slowly. It means you'll get rich surely. Warren Buffett didn't become one of the wealthiest people in history by hitting home runs every year. He did it by avoiding strikeouts and letting compound growth work its magic over 5 decades. His average annual returns aren't astronomically high, but his consistency is legendary. The compound effect of not making major mistakes is absolutely incredible over time. Let's say 2 investors each start with $50,000. Investor A chases exciting opportunities and averages 15% annual returns, but every few years makes a big mistake and loses 40%. Investor B focuses on not losing money, earns a steady 10% annually, and never has a major loss. After 30 years, who do you think has more money? You might guess Investor A because of those 15% return years, but you'd be wrong. Investor B, the boring, steady investor focused on not losing money, ends up significantly wealthier because they never had to recover from devastating setbacks. This is the mathematical reality that most people never understand until it's too late. This protection-first mindset changes everything about how you evaluate opportunities. Instead of asking how much money you could make, you start asking how much you could lose. Instead of focusing on best-case scenarios, you analyze what could go wrong. Instead of getting excited about potential returns, you get excited about downside protection. This shift in thinking is what separates intelligent investors from gamblers. But here's what makes this principle truly powerful. It's not just about investing in stocks. The same approach applies to every financial decision you make. When considering a job change, you evaluate the security and growth potential, not just the salary increase. When buying a house, you focus on what you can actually afford rather than the maximum loan you qualify for. When starting a business, you plan for challenges instead of just dreaming about success. The intelligent investor mindset becomes a way of life that protects and grows your wealth across all areas. You stop making financial decisions based on emotions, social pressure, or get-rich-quick fantasies. You start building real, sustainable wealth that compounds over time and survives whatever economic storms come your way. This is exactly how Warren Buffett built his fortune. He He didn't try to predict economic cycles or find the next revolutionary technology. He focused relentlessly on not losing money by buying wonderful businesses at fair prices and holding them for decades. When others panicked, he stayed calm. When others got greedy, he remained disciplined. When others chased fads, he stuck to proven principles. The beauty of this approach is that it's available to everyone. You don't need special connections, advanced degrees, or insider information. You just need the discipline to focus on not losing money rather than trying to get rich quickly. You need the patience to let compound growth work over years and decades rather than expecting immediate results. Most people never learn this lesson because it goes against human nature. We're wired to focus on potential gains rather than potential losses. We're attracted to exciting stories about overnight success rather than boring accounts of steady progress. We want to believe there's some secret formula or shortcut that makes wealth building easy and fast. But the truly intelligent investors, the ones who build lasting wealth and financial freedom, understand that the secret isn't about finding amazing opportunities. It's about avoiding terrible mistakes. It's not about maximizing returns. It's about minimizing the risk of permanent loss. It's not about being the smartest person in the room. It's about being the most disciplined. When you embrace this mindset fully, everything else falls into place. You naturally develop better habits around money. You automatically make more conservative assumptions about investments. You instinctively diversify your risks instead of concentrating them. You focus on businesses and assets you understand rather than speculating on things you don't. Over time, this approach doesn't just build wealth. It builds confidence, peace of mind, and financial security that can't be shaken by temporary market movements or economic uncertainty. You sleep well at night knowing your money is working for you in intelligent, well-protected investments rather than riding emotional roller coasters based on market sentiment. This is the ultimate gift that the intelligent investor gives you. A completely different relationship with money and investing. Instead of seeing markets as gambling casinos where you're trying to beat other players, you see them as places where patient, disciplined people can compound wealth over time by making intelligent decisions and avoiding stupid mistakes. The book teaches you to think like an owner of businesses rather than a trader of ticker symbols. It shows you how to stay rational when everyone else is losing their minds. It gives you a framework for making financial decisions that will serve you well regardless of what happens in markets, politics, or the economy. These principles worked in Benjamin Graham's time in the 1930s and 1940s. They worked for Warren Buffett starting in the 1950s and continuing today. They work in bull markets and bear markets, during recessions and expansions, through technological revolutions and social upheavals. They work because they're based on fundamental human psychology and mathematical realities that don't change. The question isn't whether these principles work. The question is whether you have the discipline to apply them consistently over time instead of getting distracted by the latest investment fad or market panic. The intelligent investor doesn't promise to make you rich overnight. It promises something much better. It can teach you how to build real, lasting wealth by thinking clearly about risk and return, while everyone else is driven by emotions. That's the true power of intelligent investing. It's not about being smarter than everyone else. It's about being more disciplined than everyone else. And that discipline, that focus on not losing money rather than chasing quick profits, that patience to let compound growth work its magic over decades, that's what separates the wealthy from everyone else. The choice is yours. You can keep chasing the next hot stock tip or trying to time the market perfectly. Or you can embrace the intelligent investor mindset and start building wealth the boring, steady, proven way that actually works. The principles are simple to understand. The challenge is having the discipline to apply them consistently when Mr. Market is throwing his daily tantrums and everyone around you is losing their minds. But if you can master this approach, if you can focus on not losing money instead of trying to get rich quickly, if you can think in decades instead of days, you'll be amazed at what compound growth can do for your financial future. That's the real secret Warren Buffett learned from The Intelligent Investor, and it's available to anyone willing to think and act intelligently about money.